Howdy, Jacob here. Today we're looking at Waters Corporation in the life sciences, tools, and services industry. 20.4 billion market cap on 22.3 billion enterprise value. They provide analytical workflow solutions around the world. Founded in 1958, the company's been around for quite some time now, which somewhat makes sense for this slow growth. We see about 2 billion in revenue plus 50% to 2023 to 2.9, just under 3 billion. The gross margin is up a little bit, about 1%. Operating margin up again, about 1%. Return on invested capital has been improving. We'll have to see whether this is just from repurchasing shares, which does inflate your return on invested capital due to the fact that it looks off the balance sheet. When you buy back shares, it minimizes your shareholders' equity on the balance sheet, but still gives money back to the shareholder by essentially inflating the stock price due to the fact that market cap should be the same, all else equal. We do see a little bit of debt here, though. 2 billion. I don't think is going to be too concerning, though. So just under 400 million cash-like products, 2.3 billion long-term debt, 50 million short-term debt. That 2.3, 2.4 billion in debt on probably 500 million 5-year average is just over 4 years. I wouldn't say that's that concerning. I do prefer it to be, well, it depends on the company, but anything under 2 to 3, I really prefer, but I'm not concerned by it. A 4 to 6 5-year average free cash flow times multiply multiple to long-term debt due to the fact that it's not due. It might not be due for 10 years. It's likely due at 3 to 5 years. So I don't think that's a big concern. They issued a little bit of debt recently to fund an acquisition, and it looks like they also used some cash, so a little bit of cash, free cash flow, and then issued a little bit of debt to fund this acquisition. Their use of cash is pretty heavy on share repurchases. Not so much recently, but historically has been very, very heavy. And outside of that, really just a little bit of acquisitions. Outside of this year, where there was a huge acquisition before, it's just they're really only spending 5% or so of their free cash flow on acquisition. So even if you average out this 1.28 with the last 5 years, 10 years, you're still probably looking at 15%. So not a really alarming amount of their free cash flow is going towards acquisitions, which is good because majority of the time acquisitions are pretty inefficient. A lot of companies buy companies just so they can get some growth. I know you look at an AT&T or something, the dinosaur of the uh, telecommunications industry, and they're just buying companies so that their revenue can grow. But in reality, acquisitions can make sense. I mean, you look at Google buying YouTube, the amount that they paid for YouTube is really what they're making each year. And so, I mean, you cannot say that that wasn't a great buy. The CAGR on that, I think I calculated the one someday was like, I just did a quick multiple of what I thought YouTube was worth, and then what they bought it for, and it was like a 30% CAGR since they purchased it. So that's very impressive. But again, you want companies to be making acquisitions that are making the company more efficient, not just increasing revenue. So we'll have to see how this one plays out. But let's start making some assumptions. I think we're ready for that. On the revenue growth side, the growth isn't going to be substantial. I don't think we're going to be seeing anything crazy. I could probably see maybe 4% a year, maybe just the babyest amount greater than inflation over that period. I think that a 15p market P makes sense to me because they're really not reinvesting everything. So if they were to have a 20% return on invested capital and be reinvesting it, then I would probably give them a higher premium on the P price free cash flow. But due to the fact that I think growth and moat and reinvestment is pretty average, I'm just going to put it pretty close to the historical market average. And then for margins here, let's do 23 and 20, and then let's assume they have bought quite a bit of shares historically. Let's see. So 1% would be about 200 million. And I mean, I think 400 million in aggregate per year roughly sounds pretty accurate to me. And that gets us to a price point. Sorry, that still needs to fall quite a bit before you get the return I'm looking for here. So it looks just a little bit expensive, but the company itself looks good. Slow growth, but I do think that a lot of the other numbers make it a good company, but not necessarily a good investment, since every investment is the present value of earnings and free cash flow. So hopefully you enjoyed the video, and I hope you have a fantastic rest of your day. Thank you.